The biggest thing is that when you actually raise a fund, all those LPs that you raise a fund from they become your bosses. And you're beholden to them. If one of them's not happy, or if you deviate from the strategy that you promised them in the beginning, you end up with conflict and friction. And what's really cool about the Syndicate model is that I'm more of like a professional blogger than I am a venture capitalist.
The startup investment landscape is changing, and world-class companies are being built outside of Silicon Valley. We find them, talk with them, and discuss the upside of investing in them. Welcome to Upside.
Woo!
Hello, and welcome to the Upside Podcast, the first podcast finding upside outside of Silicon Valley. I'm Jay Klaus, and I'm accompanied by my co-host, Mr. Studying All the Time, Eric Hornung.
Jay, you know that I love to hit the books.
Love hitting the books, love reading the books, love talking about the books, love writing summaries of the books.
Books about the books? That would have been nice if I actually had written a book about a book, but I haven't. Yeah, I'm back on the study wagon, which is the least fun wagon in any caravan. But yeah, every night just studying, Jay.
What are you studying for?
Right now I'm studying for a FINRA exam, which I have to do my job. So
You talking flashcards?
When there's a lot of formulas, I do flashcards, but for concepts, I prefer to just do practice questions. So there's this bank of 2,600 questions that may or may not be like the questions that are on the exam, and you just go through those until your eyes glaze over.
I am thankful that I did not choose a career path that required me to continue taking tests.
Yeah, I'm not the biggest fan of the tests and the studying. I don't really have anything interesting to say about them because they are so boring.
I don't even remember what it's like to study. I don't remember what it's like to convince yourself that you know something. I don't know. I just forget what it's like to even study. Memorization has not been my strong suit since I was probably a kid, but definitely not since college, which I feel like studying is mostly memorization.
Yeah, that's fair. It's, do you know these facts? It's definitely different than the active learning of launching a podcast or working with some software or actually building something. So the dichotomy between building the podcast and studying for legacy finance exams just makes me feel like, why do we have entrepreneurship majors in college?
But that's the price of admission for getting into the world of finance. And speaking of the world of finance, today we're talking with Peter Livingston, the founder and general partner of Unpopular Ventures. Unpopular Ventures is a new VC firm dedicated to the entrepreneurs who are proud to be unpopular. They love opportunities that are off the beaten path, particularly when they're led by outstanding teams who have discovered something surprising. But Eric, I wouldn't even have described Unpopular Ventures as a VC firm the way that it's described in their bio, because this is a syndicate, which is something that you taught me that exists. How do you Venn diagram syndicates with VC firms?
Okay, so a syndicate is just a model for gaining investment, and a fund is another model for gaining investment. In the fund model, you have LPs, they commit a bunch of capital up front, and you invest in a portfolio of deals over the course of usually 10 years. In a syndicate, you go deal by deal. So instead of saying, hey, Mr. or Mrs. LP, give me $100 million and I will do 100 deals with that, you say, Mr. and Mrs. LP, here is one deal. Do you want to give me $1 million? And they say yes or no.
And syndicates, and Unpopular Ventures in particular, is operated on AngelList, where they have over 1,000 LPs who have invested more than $10 million across more than 30 companies since starting in just early 2019. Sounds like a lot of LPs.
Yeah, but you're not dealing with all of them all the time. You're only dealing with them on each deal that they're in.
It's a new model. I'm excited to learn more about it. I'm excited to talk with Peter. We'd love to hear your thoughts on this syndicate conversation as we go through it. You can tweet at us at UpsideFM or email us hello@upside.fm. And we'll get into that interview with Peter right after this.
Hey listener, have you ever wanted to get a message in front of the Upside audience but weren't sure how to sponsor this show or weren't able to do a long-term sponsorship? Well, now you can just go to upside.fm/classifieds and let our audience know anything that's going on in your world, whether it's an event, an application, a special
coupon or deal, or just letting them know who you are, what your company does, all you have to do is go to upside.fm/classifieds and you can place an ad on this show. That's upside.fm/classifieds. Peter, welcome to the show.
Thank you. Great to be here.
Peter, great to have you on after meeting via Twitter. Gotta love that. Can you take us on a quick rocket ship through your career up until you're at Unpopular Ventures now?
Yeah, happy to. So I guess most of my background is in startups and investing in them. I studied engineering in college, and as I was graduating, I knew I want to kind of get the startup experience, and I want to join as early as possible and see what that's like. And I was the first 3 people. They had a little bit of seed funding, and so there was a founder, the VCs helped bring in a CEO, and then I was the first person they hired. Fortunate to join this brand new company called iRhythm. It was a medical device company. We developed devices for diagnosing problems with your heart. I got really lucky, basically. We ended up launching a few products successfully, grew really fast, raised a lot of money. And I stayed with them for 3 years, and they grew to about 90 people in those 3 years, raised a lot of money. And after I left many years later, they ended up going public, and we're worth about $3.5 billion now. Felt like within those 3 years, I kind of got everything I was going to learn there. And I ended up being, I was right out of college. I was kind of a junior person within the company, even though I was there early. Knew I wanted to do business school, so I went back to business school. Wanted to try to start something, and ended up starting something over the summer in between the 2 years of business school with a couple other grad students at Stanford. And at the end of the summer, we ended up getting a term sheet from Kleiner Perkins. And we all thought, hey, this is a good opportunity. Let's go run with it. So we all dropped out of school. I led that one as CEO. And that one ended up being a complete disaster, like in every possible way. Made a ton of mistakes, lost all my investors' money, fought with my co-founders. It was really the hardest experience of my life. It didn't go as smoothly as that first one. And the funny thing is, though, I ended up learning way more from the failed startup than I did from the successful one. It wasn't obvious at the time, but as I've come through that and kind of digested those experiences and kind of compared them to what I hear from others, it's just given me so much more perspective, and it's kind of given me battle scars that I think has actually made me a much better startup person, both helper and investor, and just because I've had multiple experiences that went different ways. And so anyway, we had to shut it down, finished business school, ended up working in venture briefly at GE Ventures. Around the same time that I was at GE Ventures, I started kind of doing some tiny angel investments in friends' companies, like very small, like 10K in many cases, occasionally like 25K or something like that. But did like 10 investments in 8 friends' companies, and a lot of them ended up working and growing and raising more money at higher valuations. And I found I was really enjoying that, and I simultaneously discovered I hated corporate venture. I realized I don't believe in that model. There were a lot of great people at GE Ventures. They're all very smart, and I really enjoyed working with them. But I discovered that I don't actually believe in that model as like a legitimate part of the startup ecosystem. I found it was very frustrating. So basically decided to leave that and focus on angel investing full-time as an individual. And over the subsequent 6 years, just wanted to get out there and learn as much as I could. So did a ton of small investments. Ended up doing I think about 130 during like 5 or 6 years. It was a mix of direct and through I was part of a couple of angel groups and did some with them. And I was also a very early LP on AngelList. And so invested through a number of people's syndicates as that was kind of starting out. And feel very lucky that it went really well. Lost money on a ton of deals, but I was my big fund returner was I took a big position in Bitcoin very early on. Have some other good ones that are doing well, but it just got to the point where I kind of had more of a track record. I don't know if anyone ever actually knows what they're doing, but at least it seemed like maybe I knew more than the average person. And anyway, people started to ask if they could invest behind me, and that's what led to me creating this my syndicate now on AngelList. And I should pause there. That's probably a whole new chapter since you guys want to talk about syndication.
I do want to get to syndication here shortly, but I've got to double click on this position of not believing in corporate venture capital and hear a little bit more why you disagree with that model and why you don't think it's a legitimate part of the startup ecosystem.
Yeah, well, the simplest reason that I don't believe it works is basically double bottom line, where you're kind of optimizing for 2 things at the same time. And startups and venture capital as a whole is so hard to begin with. The statistics are crazy. It's something like half of venture funds don't even return 1x the money. It might even be 3/4 don't even beat public stock market benchmarks. Like it's really hard to be a good venture capitalist to begin with. Now, if you take the position of corporate venture capital, where most corporates are not doing venture capital to make money, they come in to do it for strategic reasons. So, like in the case of GE is one example. When I was there, I don't remember what the numbers were, but they're making so much money every year from the main businesses. It's like, I think revenue is like hundreds of billions or over 100 billion, and profit was like, I don't remember, it was probably like at least $10 billion of profit every year. And so when you think about that, and then you think about, okay, let's say this was the best corporate venture fund ever, and they got in on the next Google or the next Facebook or Uber or whatever, most likely they'd probably get a couple percentage points in that, and goes public, and it would take 10 years for this to happen. They make these investments, and then the company goes public, and they got the best venture fund ever, and they own maybe 2% of Google when it goes public, and it's like $2 billion. But wait a second, they made $10 billion of profit that year. So it's like, even if they have the best venture fund ever, it doesn't matter to the overall corporate enterprise. So what that means is that the only reason it makes sense for them to do it is actually to not to make the money, but to find strategic things that help their core businesses. So maybe if they can increase their $10 billion revenue business by plugging something in by 10 or 20% over the next year, well, then that'll create $2 billion of value for them or something like that. But the thing is, when they come in with that mindset, that's not helpful to the startups. Like, no startup wants to be beholden to GE as their, like, most startups are trying to build value for themselves. And so it creates this mismatch where, they're out there saying, oh, we're investing money, so come talk to us. But that's not really what they're about. And it just, so then what ends up happening is oftentimes they make bad investments or they get really bad adverse selections. The best entrepreneurs, the Googles, the Facebooks, the Ubers, whatever, don't come and talk to them because they don't see value in them. They've already been warned away. So they end up being in the not top tier companies, and they lose money. And then the higher ups in the corporate are like, why are you losing all this money? And where are the results that, and then it usually doesn't really work that they deliver those big results that were envisioned, and it just kind of falls apart.
Do you think this double bottom line concept, you said it doesn't work because it's very hard to be a good venture capitalist and essentially be something else as well. Do you think that means that impact investing in sustainable and clean tech funds that have a mission associated with them will never be the best venture funds?
It's hard to say. It depends on if the second line is well aligned with making money. If you catch the next wave of something, like if clean tech finally happens or something like that, then yeah. And then also, like, one thing I believe is like 99% of entrepreneurship is already good for the world. Like, it already has a positive impact. Like, you can probably spin most startups as like, this is good for the world in some way. Because, they're producing a product that people want, adds value to their lives. They're creating jobs, they're creating wealth. It's like they're like business, and most of capitalism is actually very good to begin with. And so if you come in with the mindset of, oh, like, I want to create products that actually help people, and you're kind of loose with that definition, well, usually when you help people and you create value in their lives, you make money, and that's a successful business. So I think if you come in with that mindset, then it's good. But I have also seen impact investing come at it from like, we think the world should be this better way, and we're gonna like try to force everything into this other way, but they lose sight of like actually adding value to individuals' lives or making sure that they're producing something that people want. That's when they run astray. I think within the right flavors, investing with the mindset of you want to make the world a better place is probably actually fun.
I want to dive into the syndicate model. This will be the first time we've covered it on the podcast. We may have alluded to it before, but for beginners, can you explain what the syndicate model is just at a basic level?
I guess taking a step back, it's pretty new. So maybe the right place to start is some history of angel investing. So this idea of investing money in companies and getting ownership from individuals is not new. I mean, venture capital has kind of aggregated it, where they raise money from larger pools of capital and invest in companies. There have also been these things called angel groups for a long time, where it might be 20 or 50 or 100 people, where they all kind of meet together and have companies come and pitch them, and they kind of all put in checks of 5K or 10K together and invest in the company and help. At the basic level, this idea of kind of pooling people's money together to invest in companies and help the companies get going and get ownership and create wealth has been around for a while. Now, AngelList was kind of the first to pioneer this model that you're calling of syndicating, where they've kind of taken the concept of an offline angel group, where it's a group of people meeting together and kind of deciding on what to invest in and pooling their money, and they've put it online. And It's changed things in a few ways. So the first is it's much bigger. Conventional angel groups before, wherever we meet, you couldn't really have them be more than 50 to 100 people. But with AngelList, there are thousands of active people on there that are participating in these basically virtual angel groups and investing in companies. AngelList has kind of figured out some kind of political and governance things around how you manage successful angel group investing that has made it much more successful on this online platform than it conventionally did with angel groups. But I guess I'll kind of talk about the mechanics of this. So the way AngelList has created it is that there are individual syndicate leads, and that's what I am. I'm a syndicate lead. I have invited lots of other people to back my syndicate, which means that they follow me, kind of like someone might follow someone on Twitter. Whenever I find a startup that I want to invest in, I agree to invest with the founder. We negotiate a valuation, and we agree that I'm going to invest and I'm going to share it with my syndicate backers. And I then write up a memo about why I think it's a good investment. And I share it with all my backers that are on AngelList. And they get to then individually decide if they want to invest in that deal, for how much. And they commit through AngelList, send the money through AngelList. And I basically take everybody's money, or AngelList really does it. I don't even have to touch the money, but we aggregate all the money. And then we close the deal with the company, and I write them a single check from it. It's basically all the money that I collected from my backers into one. And I kind of act like a miniature venture capitalist.
Why would an investor decide to invest with you or with any syndicate over a fund or just over doing deals on their own?
A lot of people invest in funds, but it's not that exciting. When you invest in a fund, it's kind of a black box. Sequoia raises their fund, you say, here, take my money. Yeah, they have a good track record of producing amazing returns, but you don't really get to participate in the process. On the other end of the spectrum, there are a lot of people that are excited to support and be involved with individual startups, where they learn about the companies, maybe help them, and kind of curate their own investment basket. And so people do that as well, where they go and find the startups themselves and invest. Now, the thing with being an individual angel is it's really hard to get good deal flow. The best founders already kind of know who the good VCs are, and they go to them first. Or they go to the people they already know first that they know are active angels. And if there's somebody that's just kind of starting out investing, they're going to see the best deals last, or they won't even see them. Because first those founders go to all the VCs, and the VCs will either say yes and invest already, or they say no, and then they go down the stack, and then they say, okay, well, I'm going to go to my friends, and then maybe the friends say no, and then they go down. And it's only when, like, at the point that a random person who doesn't have a track record or a reputation as an angel, when they see a startup, it's usually been picked over by everybody else already. And so it's very hard as an individual, when you have no track record and no brand, to actually see the good deals first. So syndicates kind of bridge those two worlds, where these syndicate leaders, like myself, have built up a reputation and a track record as being, I guess, I don't know what the right word is, maybe honorable investors. Like, I have a track record of founders that have taken money from me. I haven't been an asshole. I've been very supportive and helpful in a lot of ways. And so a lot of the founders I've invested in actually introduced me to other founders to invest in. And new founders that don't know me can look me up online and see that I've invested a lot and I have good references, and it's like, okay, I'm a normal guy. I'm probably a safe person to take money from. So I kind of have that established track record where I actually do see a lot of deals very early and first. And so my backers, by being with me, they can still pick and choose individual startups to invest in, but they're able to see better deals than they might have been able to see otherwise as an unestablished angel investor.
If I can repeat some of this back in fairly layman terms as the layman of the show here. So it sounds to me like by creating a syndicate, you have more financial power and therefore are more attractive to startups earlier on. So you get better deal flow. That's good for you. That's good for the syndicate backers. And for the startup founder, they see you as an opportunity to obviously get more money into their company. So when you're talking to a startup founder and you're starting to negotiate these deal terms that you're going to come with your syndicate, bring it to them with their deal memo, what are the expectations? Like, do you have a minimum commitment that you have to bring to the table for the founder to say, here are the terms, but you have to hit this and you have to go and get that much from the syndicate? Or, what are those thresholds you have to know and at what point?
In terms of a minimum, it actually has more to do with the setup costs of running an SPV or running a syndicate. So the legal costs of creating a new, effectively LLC it becomes like a mini corporation, takes all this money and invests it in the startup. There's a cost associated with that. And the cost is about $8,000 right now, which it sounds expensive, but it's actually a very good deal for everything that's involved in managing that. So to make sure that that $8,000 is not a huge cost out of kind of our investment. Both I and AngelList also tries to always make sure that the syndicates are always at least $80,000, because at $80,000 it's only a 10% fee, which is still high. But the bigger it is, the lower that $8,000 is as a percentage of the total investment. So kind of the minimum is $80K. I usually try to get it to at least $100K. And fortunately, because I am a big and established syndicate lead with a big following, I almost always get at least $100K from my backers on any deal I want to do. In terms of kind of negotiating the amount with the founder, it's a dynamic process. So on an individual deal, I can usually estimate with some, like, not great certainty, but some certainty about how exciting the deal is going to be to my backers, just based on what I've seen in the past. I'll usually tell the founder, look, here's how it works. I'm going to put it in front of my backers. I think we'll get this amount. We might get more, we might get less, but it'll be a dynamic process where we kind of communicate about it. And I can usually say, look, I'm 100% sure we're going to get 100K, so hold that for me. There's probably a 50% chance we get $250,000 and maybe a 20% chance we get $500,000 or more. And as my backers commit and I see how much we have, I communicate with the founder and kind of figure out how we fit the right amount of money.
How much are your backers typically putting in each?
It's a range. So I set the minimum for them at $1,000 a deal, so it's very low. I think that anyone who wants to invest in a startup should be able to. So I like to make it more accessible. Not all leads feel the same way. Some set higher minimums, but I try to do it as low as possible. And then I've had backers put in as much as $400,000 into a deal individually. So I think most are 5K and under. I get a ton of checks that are 1 to 5K. I get a few that are 10 to 25. Occasionally I get a 50K check. And then every now and then for like a very hot deal, I'll have some big whale that wants to put in hundreds of thousands of dollars.
One of the things that we have heard about angel groups, you talked about them in your history segment there, was that from an entrepreneur's standpoint, they are just too slow. Is the syndicate, does it still have that kind of legacy slowness, or are these backers seeing it and saying yes, no right away?
Absolutely. So I alluded earlier when I was talking about angel groups that there's some kind of political and governance type things that Angels has actually overcome. And that is the biggest one with angel groups. So angel groups have a bad rap because they're slow and they negotiate too hard and often don't add that much value. I think what that has to do with is historically they've been organized very democratically, where usually, so I've been a part of a couple of angel groups and I saw this firsthand, where you might have 50 members and they all try to vote in some way to get comfortable with the deals. So there's a lot of socializing, and most of these people are total amateurs. Like most of them have like a different job or other hobbies or whatever they're doing, and they're not singularly focused on making this fast. So yeah, it gets bogged down. It takes too long, and because they're so slow, the best companies don't go to them in the first place. So there's a big adverse selection problem for angel groups, and as a result, they usually see the weakest companies that have no other option and are willing to spend 6 months trying to get money out of them. And because they only end up producing bad returns in general. Now, the way AngelList has overcome that is they focused this around these syndicate leads that have a high degree of agency. So there's no democracy in my syndicate. And sure, I would love everyone to have an equal say and all, but we can't be fast like that. So the way it works is I can run fast, I decide to do the deal, and I put it up to my backers and say, who's in? You have 5 days to decide. That's it, we're going to go. And so there's no haggling, there's no negotiating with my backers. It's just, are you in or are you out? And because of that, the entrepreneur only deals with me. The other thing with angel groups is usually they welcome anybody. And there's some people that are either assholes or not very smart or ask dumb questions and take up the entrepreneur's time. And so when the entrepreneur is taking money from that conventional angel group, they're often dealing with the lowest common denominator, the guys that are bored at home and have nothing else to do and just want to who knows what. But with the syndicate model, the founder gets comfortable with me. They know they're only dealing with me. They can have access to my backers if they want to, but they don't have to. And I kind of shield them from all my backers. And my backers are only dealing with me. So because of that single point of leadership and the agency around that, it's kind of overcome those political challenges you mentioned with angel groups.
I want to talk about that role of shield that you have to play. I see from your syndicate profile, you've had 675 unique LPs that have invested. Can you help me benchmark that against what a typical angel group or fund might have in terms of number of LPs, and if that makes a functional difference for you?
Yeah, well, it's bigger than just about anything historically. So the conventional angel group has 20 to 100 individuals. A venture fund rarely has more than 200 LPs, and usually it's less than 40. Usually they just want a few big pools of capital because it's a pain for them to do capital calls. And for me, Angels has made it super easy. It's not all those 600 people that participate in every deal. On any individual deal, it's usually anywhere from 30 to about 150 people that participate. I believe that speed is very important in getting into the best deals, and so I really push for it. So if there are individuals in my syndicate that are being too slow, or like maybe they've committed, and most, what sometimes happens is I'll get most of the money that we're going to invest, and there'll be one or two people that haven't wired their funds yet. And I'll check in with them once and say, hey, where's your money? Like, we got to close right now. And if they don't respond, I just kick them out of the deal. And they understand that, and it's just the way it is. And because there's no tolerance for either bad behavior or being slow, and it's just, we're going to move on without you if you miss it, and you might miss out on a great deal. It has not ended up being a problem.
How often are you coming in before a company has a lead, or are you ever leading around? And you said $100,000, $250,000 checks, so it sounds a little smaller.
It's a mix. I have a lot of deals where I participate as part of a bigger round, and there might be a lead or not. And then I have led a number of deals. So I've led both very early pre-seed deals where like maybe they're only raising 150K or 250K, and I put in a 100K check and I was the effective lead. I've also led more kind of core seed deals. So I had a couple deals where we brought in about $700,000 on a deal, and I was the biggest investor. And because we had so much interest from my backers, we were able to say, hey, we'll serve as your lead. I'm a board observer on one. We negotiated terms, and we're the lead, and other people came after us. So it's both.
Okay, so talk to me about why you didn't go the traditional fund route, or why you haven't chosen at this point to go to the traditional fund route. Fewer LPs, maybe you can raise more. Seems like you've proven a track record.
Yeah, so it's funny. I actually did try to raise a fund first. So after I had put up good numbers as an angel, I went out and tried to raise a normal fund. I went and tried to raise $20 million, and I just hit a brick wall. There were two main pieces of feedback there were three. That all the big LPs, reasons they said no. So the first was, so I'm from the Bay Area, I'm from the San Francisco Bay Area, but my wife and I decided like 6 years ago we wanted to try something different, so we went to Miami. We're living in Miami for 5 years. I put up most of my good angel investing returns there, and I initially tried to raise the fund from Miami, and all the LPs hated that I was in Florida. They were like, there are no good companies in Florida, and you have to be close to your companies. And I don't agree, but the customer's always right. So we decided to fix that. We came back to California about a year ago, just to kind of try to move forward in my career in that way. The second piece of feedback was it doesn't count when it's your own money. So I'd done this all with my own money and put up really good returns. And they were like, well, it only counts when you invest other people's money. And it was partly that, but it was also the check size. My checks were tiny. They're like, it's very easy to get 10K into a hot deal. Can you really get $250,000 into a hot deal or $500,000? And so they want to see more track record, bigger checks. And the third was I was trying to do it as a solo GP. And a lot of them don't like that. They like to see, a full partnership of multiple people they're investing. So I pivoted from the fund to do the syndicate thing. So both moved back to California to overcome that piece of feedback. Created the syndicate to invest more money with other people's money and prove that out. But I wanted to stay as a solo GP. I really like operating independently, and I like how fast I can be and the agency that comes with it. And the ironic thing is that within a few months of doing the syndicate, I was already moving more money on a monthly basis than I would have been with my $20 million fund. So with a $20 million fund, you usually invest half in first investments over maybe 3 years, then you reserve half for follow-ons. So it might be $10 million over 3 years. And already about a year and a half in, I've invested over $11 million. And so moving more money than I would have been there. And the thing that's been the biggest thing is that when you actually raise a fund, all those LPs that you raise a fund from they become your bosses. And you're beholden to them. If one of them's not happy, or if you deviate from the strategy that you promised them in the beginning, you end up with conflict and friction. And what's really cool about the syndicate model is that I'm more of like a professional blogger than I am a venture capitalist. I have over 1,000 investors behind me. And if one of them is unhappy with the types of deals I'm doing, or doesn't like the strategy or something like that, fine, go somewhere else. Like it's no big loss, and they're not committed. They only committed to the individual deals they wanted to. And I've really been enjoying that freedom. And as a result, I've decided I'm actually not going to go back and raise a fund. I really love the syndicate model. I'm able to move all the money I would have been. I'm making enough in terms of economics. The other thing about this is actually a pretty unpopular viewpoint. most people see the syndicate as a stepping stone to being able to raise a fund. It's kind of like the minor leagues to be able to get up to the major leagues. And I guess an experiment that I'm kind of pursuing is what if you invert that? What if no one has really become a long-term professional syndicate lead before it? And what if I do just stay here and keep growing it? Why is it better to raise a fund? Why does everyone prefer to go do that?
If you go back down that idea of being a blogger, how do you think about platform risk with your current syndicate and the fact that you're beholden to AngelList currently?
AngelList is awesome. I've had no issues with them. You're right that there's platform risk, but the LPs that are on there are investing in me and my deals because they trust me. And yes, they also trust AngelList. But there are actually cases in the past of syndicate leads on AngelList leaving that because they weren't happy with the structure there. And they basically took all their LPs with them, and the LPs kept investing with them because they trusted that individual. And so like Jason Calacanis is one. He was a syndicate lead on AngelList first. Now he has his own platform off it. And then there are other people that have gone and raised their own funds, like Ramtin Naimi at Abstract VC and Zach Coelius. Although Zach still does syndicates. Brandon Wallace at Fifth Wall, first was a syndicate lead before raising Fifth Wall. So I don't know if that risk is there, at least not in a big way. But then also, I've just found AngelList to be so awesome in every way. So they take a portion of my carry, but it's pretty small. It's about a quarter of my carried interest. And they do so much in the background that makes it, it's a very good deal for me. If I were to do this on my own, I'd have to hire people, and it would cost me more than what I paid AngelList. Because I'm on AngelList, it's kind of a continuous investor finder for me. So people join AngelList, then they look at syndicates to back, and they end up with me. So by staying on there, I think it's keeping me growing faster than it would have been if I was off AngelList.
I saw that you built that syndicate to more than 500 people faster than anyone else has ever built an AngelList syndicate faster, or to 500 people. And a lot of that comes down to this trust that you're talking about. What is it about Peter Livingston or Unpopular Ventures that built trust with professional investors faster than anyone's ever done it on AngelList?
Well, I mean, to be honest, I do feel proud that I grew quickly. I think part of it is simply that AngelList was more established when I first kind of broke out. AngelList their syndicate product has only been around for 5 or 6 years. The people that started syndicates 5 years ago, there weren't more than a couple hundred people to even recruit to be in their syndicate. And then I also did a couple growth hacking things on AngelList that I guess no one had ever done before. Effectively, I cold emailed everybody on AngelList and said, back my syndicate. And that's not easy to do. Actually, it took me about 6 weeks to do it. It's very manual. And from that, I was able to get 300 or 400 people. And then after that, I just kept doing good deals. And people would tell their friends about, like this guy Peter's putting up good deals. I think that's all there is to do it. That's all there is to it. I try to make really good investments. I try to build trust with my LPs. I try to show that I have good judgment. I feel very fortunate that they have trusted me, and it's continued to grow. So it's over 1,000 investors now.
Is there a near-term economic incentive to running a syndicate? So in the fund model you said that $20 million fund, well, you'd be pulling in $400,000 a year on that $20 million fund through the 2 and 20 model. What about in the syndicate model, which is deal by deal?
Yeah, so in a syndicate, there's no management fee, or at least not yet. Some syndicates are trying to play around with that, but historically, syndicates usually don't charge a management fee. And so there is no near-term cash payment. I purely get carry. But the one way that the carry is different in a syndicate versus on a fund is that it's deal by deal, whereas on a fund, the carry is on the whole portfolio of investments. And individual deal carry is more attractive because in the larger fund, it's really hard to return the whole fund. It usually takes a long time, maybe 8 or 10 years. So you might have one deal that returns 20% of the fund, and then another one that returns 50%, and then another one that returns, and finally in year 8 or 10, you finally return all the money that was invested, and then you start producing profits and you earn the carry. But with deal by deal carry, I only need one to return more than we invested, and I'm already starting making money. So usually when you're investing, there might be a deal that breaks away quickly and produces an exit in year 3 to 4 that might return 20-30% of the fund, and I would make money then rather than waiting to return the entire thing. So that's attractive. But yeah, there's no management fee. I feel fortunate that I'm in a position where I don't need that salary right now. Also, that $400K sounds like a lot on a $20 million fund, but the reality is to run that fund, you have to employ a lot of people. And the LPs are going to expect you to hire people with that. They won't be happy if you take all $400K salary. So, in the end of that, your salary might be like $150K, which it's still good. And yeah, you don't end up profiting that much from the management fees. So.
Does that mean there's kind of like a barrier to entry for in addition to being accredited, which I believe you have to be a syndicate lead on AngelList, if they change the syndicate rules and it's essentially anyone who works at a financial firm becomes accredited, you still have to essentially fund yourself for a few years while your investments mature and until they eventually exit.
It's true. There is that barrier to entry, and I wish there wasn't. I wish it was more equal and fair to everybody. I know a lot of the syndicate leads do it on the side. Like they have a main job that pays them a salary, and then they do, they run deals through their syndicate on nights and weekends. So that's one way to do it.
Is there a world out there where GP staking for syndicate leads can become a thing? So essentially investing in a syndicate lead as if you're investing in a startup with their runway and burn?
Yeah, potentially. I think Ramtin Naimi with Abstract VC actually did that. So he had something where he sold part of his GP to a bunch of top tier VCs like Mark Andreessen and some other people. So I think they gave him cash to live on and operate in exchange for part of his GP. So yeah, there are ways to do that.
You answered a ton of my questions as far as how syndicates actually work. We didn't spend a ton of time talking about Unpopular itself. What types of companies are you looking for and predominantly investing in?
Yeah, it's really mixed, and it's all over the map. A couple of anecdotes on this. So the first is that most of my best investments, as I was kind of playing around with angel investing and just learning and investing in everything, most of my best investments were the ones I couldn't get anyone else to do. And so that was a big learning for me. And in contrast, these hot deals that had tons of people in them and seemed famous and got a lot of press, I did a lot of those, and most of them did not do that well. And it's not a new insight, really. A lot of people have talked about this before. But yeah, the only way to make money in any kind of investing, in startups and public markets, is to be what's called non-consensus and right. So Andy Rachleff talks about this. He was one of the founders of Benchmark, but he got it from Howard Marks at Oak Tree Capital. And the idea is if you kind of distill investing it down into a 2x2 matrix. So on one axis of the matrix, you can either be right or wrong. And on the other axis, you can be consensus or non-consensus. Everybody knows that you want to be right. But what a lot of people miss is that if you're right, but you invested with the consensus view, you don't actually make much money. You don't beat the market because everything is priced in already. The tricky thing is that when you're investing, you don't know if you're going to be right or wrong when you're making the investment. You only know if you're going to be consensus or non-consensus. So therefore, the only thing that you can actually optimize for at the beginning of the investment is to be non-consensus, and then simply hope that you're going to be, sure, you want to try to be right. But yeah, the only way that you make money in any of this is to start by being non-consensus, and then you get the 50-50 being right. So anyway, what I found is that the unpopular deals still lose money in a lot of them, but the ones that I'm right on, those are the ones where I made big money. And then the other funny thing was when I was trying to raise my fund, a lot of the LPs really wanted me to focus and concentrate. They said, well, we want you to either focus on digital health or AI or some core area where this was going to be my expertise. And I found I really don't enjoy that. And I don't feel like it's a good way to personally invest. I prefer to be more diversified, where I'm in all kinds of different businesses that are all attractive in their own ways. And so I've ended up diversifying a ton. So I'm in financial technology, I'm in real estate stuff, I'm in a lot of transportation deals. I've invested all around the world. So companies that are in developing markets, I've done a lot in Latin America, one in Africa, a couple in Pakistan. I've invested in, I'm doing a deal right now, a follow-on in a food company. It's kind of like an Asian sauces company that I'm just incredibly excited about. The team is super good. The business is great. They've really executed well. But yeah, I feel like the best opportunities in all of life, not just from investing or startups, but everything, tends to come from taking the road less traveled. So in everything I do, I try to kind of go to places where no one else goes and kind of find things that are really weird and different. Most people are like, what? Like I've never heard of that, or how could that be a good investment? But then once you kind of dig into it and kind of really look at it, it's like, that is actually pretty interesting.
If you put a deal in front of your syndicate and all 675 backers said yes, would you pull it?
That's a good question. Probably not. The thing is, it's like, as a syndicate lead, I'm also in some ways I'm a VC, but I'm also kind of like a matchmaker, where I'm also just trying to put opportunities in front of people that they want to invest in. And because they're making the choice, I don't get the final say on if they're going to invest in it or not. I put up the opportunity and they make the choice. A big part of my job, it's not just to choose, it's to put good choices in front of other people. And if other people want to make those choices, then I also have a responsibility to let them make that choice. So in that case, it hasn't happened. I don't think it ever will happen.
You have this quote that the next Sequoia is going to be a syndicate, not a fund. And I really like that quote. But I want to know, for the listeners' edification, why you think that.
Few reasons. First, the trend is very much in favor of syndicates. This has appeared, it's growing super fast, and there are a lot of advantages over it, over what conventional venture funds have. So I think that, Naval said this recently. It's like when you have a platform shift, you have to move over to that new platform, otherwise you get left behind. And most existing businesses of all kinds have a very hard time changing platforms, but the ones that do succeed in that new paradigm. So there are a few things that are really interesting about a syndicate. So the first is that all of my backers are individuals, and a lot of them are really impressive people in their own ways. So they're all accredited, which not always, but in many cases means that they've had a high degree of success in their chosen careers. They're spread around the world. And so oftentimes when I'm competing with another VC for a deal where the founder has multiple choices and they're like, who do I take money from? And maybe they have some VCs in already, but I'm going head to head with another VC. And they say, why should I take you? I actually have a very easy answer. It's, who do you want your money to come from? A bunch of boring pension funds? Or 100 individuals spread around the world in a variety of professions that can all help you in a bunch of different ways? And it's an easy choice. They're like, whoa, that sounds awesome to have a bunch of individuals. And so these big conventional VCs, sure, they have some individuals, but that's not what they're about. You kind of get that individual partner you work with, that's it. But I bring a whole village. The second thing is I've effectively built a better scout program than Sequoia has into the Syndicate Model. And this comes from the deal-by-deal carry. So you might have heard Sequoia and other venture funds have scout programs. I think Sequoia has over 100 scouts. And basically when, each scout has a certain amount of money they get to invest and they get kind of a carried interest in that. But it's pretty small for individual scouts. And there's a lot of them. And it works well. I mean, Sequoia is the best. Like, this is one of those things where I'll probably be wrong. The Syndicate, it's going to be hard to overtake Sequoia, but I still think that there's some structural things that are different. So I don't mean any disrespect to Sequoia. They're amazing. They're the best in venture. But the scout program that I've built into my own model, what I do is I share a huge chunk of my carry with anybody who refers me the deal that I do. What I found is that on my good deals, I pay my scouts more than Sequoia pays their scouts. So as an example, if someone simply sends me a deal and I do it, they do no work, it's simply a referral, I give them 1/3 of my carried interest. And if I bring in $500,000 or $700,000 on that deal, their carried interest on that is equivalent to 25, sometimes 50K for that deal. It's equivalent to the upside of an angel investment. And I have over 1,000 LPs in my syndicate, over 100 portfolio founders that know me, tons of friends, huge network. And all these people know that if they send me a deal and I do it, they get paid a lot, and probably more than they would get paid if they brought it to Sequoia. And so as a result, I'm seeing deals first and better ones in from around the world because I kind of have this unlimited scout program. And sure, maybe Sequoia could do it, but it's different. Like it's hard to pull out that carry and do it in the same way or do it at scale or do it in a big way. So I guess where I'm going with this is because of this kind of inherent scout program where I can kind of carve out that deal-by-deal carry and share with anybody, thousands of people, anyone who wants to send me a deal. My deal flow has gone through the roof. I see probably like 50 deals a week, and they're all very good. I have a very hard time choosing between them. And so I'm not going to be the only one that does this. So other syndicate leads are doing this as well. A statistic that's remarkable. So AngelList has only been around since 2012. They've already moved $1.8 billion through the platform, and they track everything. They are now in 36% of all top-tier US VC deals. 36%. They've only been around for 10 years. And so you kind of extrapolate that forward, and there will be more syndicate leads, and more LPs on there, and more deal flow passing through here. And I'd like it to be me. It might be not. There's a lot of talented people. But I do think that we're going to this place where AngelList and all the syndicates that exist on it are going to be extremely powerful and a major part of the startup ecosystem. Maybe not in the next 5 years, maybe not in the next 10, but I bet in 20 years, you're going to see syndicate leads on the Midas list. Maybe longer term, this will be considered as big and on par with say, Sequoia, or maybe overturn it.
Awesome. Well, if people want to learn more about you or Unpopular Ventures after the show, where should they go?
Go to AngelList. Type in Peter Livingston, Unpopular Ventures. That should show up, or go to AngelList and search for me.
All right, Jay, we just spoke with Peter from Unpopular Ventures. We had the birds chirping in the background. We had some people coming up and asking him for favors. It was quite the outside quarantine Starbucks interview.
Yeah, and as expected, it delivered on teaching me a lot about a model that I knew nothing about going in. Still sounds like, a lot of people to deal with, but I am much more bought into the idea that it's really not more burdensome than running a fund. I love the idea of kind of going deal by deal. He said something that resonated really hard with me, which is basically, I'm more of a blogger than an investor at one point, which makes a lot of sense. I mean, he's essentially built an audience, and he goes to that audience and says, here's something that I think you're interested in, take it or leave it, which is pretty great. I mean, because you only have to deal with the people that want to take it, and you move forward.
Yeah, I like the concept of being a matchmaker for deals, saying, yes, my stamp of approval's on this, but you don't have to say yes. And he knows that if he's doing a good job by the amount of people that are saying yes to each deal and how oversubscribed something is or how much money is flowing in. So there's some pretty cool metrics there that can show that his deals are doing well and gaining support.
And he's in a pretty good position to protect his position as one of the largest AngelList syndicates here, not only because, the rich tend to get richer, so to speak, but because something you brought up at the end of the interview, which I hadn't thought about, this is quite a long-term play with no immediate reward whatsoever and a pretty large time commitment that I would guess you have to put into this to talk to a ton of entrepreneurs, decide on the deals that you're really interested in, then write something compelling to present to your LPs, and then work through all the terms. Like, that's a lot of work for something that, you hope as part of the portfolio pays off 10 years down the road. But with no management fees in a syndicate, that's a little bit of a moat against other people who want to come in and start a syndicate right away.
Yeah, I mean, it's near impossible if you wanted to cut your teeth running a syndicate that you could do what Peter's doing full time without the personal runway to get there. I mean, that's a huge just barrier to entry for anybody who's in their 20s and 30s and hasn't exited a couple $1 million business, or even their 40s. I mean, it's just a lot of runway. And I think it goes to like your margin is my opportunity type thing, where funds need to have that 2% overhead, but syndicates, I guess, don't. Or maybe they do. Maybe eventually there will be a platform that stakes syndicate leads and buys essentially GP shares so that people can get off the ground and start investing.
I also really like that, as an individual, he is still investing in a portfolio of companies, but because it's not all being deployed from one fund, he's not trying to return that fund. Like, when things start to exit or liquidate, they can happen one by one and go back into his ability to invest, which is one of the things that I think is limiting and annoying about this venture capital structure that we've had for decades.
Are you saying there will be no forced liquidations because of how he's investing?
Yeah, and he doesn't have to think about, I guess I'm not super familiar with, or as familiar with venture capital to say that this is materially different, but he doesn't have to think about like this individual fund, what is the makeup of that? He can really go like company by company and not worry about, okay, these 10 companies I invested in, that's all a 10-year experiment. Like, you can really stagger the experience a little bit more. And because the LPs are investing deal by deal, they can kind of see the outcome of their investment faster because it's not the entire fund. I don't know. Am I thinking about that the wrong way? Call me out on it.
No, I think you're thinking about it from the perspective of the syndicate member. There's some pushback, I feel like, in the LP community, or maybe it's in the fund community on behalf of the LP community. I'm not really sure who's leading the marketing charge here against syndicates, but they say that it's unfair because it, for the syndicate lead, essentially just represents a call option. They don't have to worry about returning a fund. So yeah, if you got in the right deal of those 10, great, good for you, LP, you picked the right deal. And the GP or the syndicate lead gets all the upside of that one deal and doesn't have to worry about the other deals. There's probably some merit to that, but there's also, if like Peter's doing, he's investing in every single deal, he has skin in the game and he's not getting a management fee. So I personally think the syndicate model is better aligned. But the traditional way to do funds, I think people say, oh, but that's not how you play the game, kind of thing. It's like when Michael Jordan came to the NBA and he was just like flying over everyone and dunking, and everyone's like, well, that's not really how you play the game. You're supposed to be shooting mid-range jumpers.
You been watching The Last Dance?
No, I have not.
Oh, it's great. You should watch it. Something you just brought up that honestly I didn't realize until recently. And so if there are listeners out there who are a little naive like me, I wanted to point this out. When a fund raises a fund, say it's $200 million or something, I had always assumed that meant that they immediately had that $200 million on hand in their account. But it's not that. It's this capital call structure that you're talking about. Can you explain a little bit more of that?
Yeah, so it varies fund by fund, but when you raise $200 million, maybe 25% of that comes in day one. And then once you get to a place where you've invested that 25% or used the management portion of that 25% to pay salaries and you need to make another capital call, you go out and you, depending on what the fund structure is, maybe you call another 25%, or maybe you start with 50% and you have one capital call 3 years out, whatever the terms are. Over time, that LP is committed, legally committed to giving you that money, but they don't need to write you a $10 million check on day one. So one of the things I want to talk about with the syndicate model and why I'm personally so bullish on it is that the fund model is very like traditional finance, and you can use certain tools to go out and find deal flow or to review a deal, and you can use Notion and collaborate better, but the underlying structure itself doesn't scale well.
What do you mean by that?
As you go up, the way to scale a VC fund is to do bigger deals, not to do more deals. So the incentives for a VC fund is, okay, you start with a $17 million fund, that works out well. You go raise a $100 million fund, and now you're doing both seed deals and Series A deals. And then that works out well, and you say, okay, I'm going to go upriver again. And now I'm raising a $200 million fund, and I'm going to do Series A and Series B deals. And all the meanwhile, this is good for you because you get 2% of a bigger and bigger pie going forward. Because of that, it's better for you to do, at a $200 million fund, it's better for you to do a Series B deal or a suite of Series B deals than it is for you to go back down and do 500 pre-seed deals. Because the fund economics, it's harder. You would have to hire so many more people to do all of that due diligence and everything, right? On that raise side, you're still raising from 40 or so LPs. They're giving you all of this cash, and it's big and it's upfront, and you're doing it in less and less deals because you want your portfolio to stand for itself and return the portfolio. On the syndicate side, you have an ever-changing LP base, and it's all set by like technology. The syndicate as it currently exists would be so hard to pull off without great technology. And that's why Peter is talking about how great AngelList has been to him. And remember, AngelList takes 5% of your 20% carry. So they're sitting out there with call options on essentially everybody that's ever raised through AngelList. And if they do well, AngelList is going to make so much money in 10 years on this. But because of having that platform, and it's like a technology first versus a legal structure first entity, Peter could have 20,000 LPs and do 500 deals a year with not that much more overhead, as opposed to a fund which would have to do the same amount. So Peter mentioned it in the interview itself. He deployed more capital in a syndicate than he would have been able to in a fund. And that scales over time, I believe.
Well, we'll find out if you're right. I think we should keep talking about the syndicate model and maybe talk to some more syndicate leaders here on the show as we move forward. We'd love to hear your thoughts on this episode about syndicates and whether you want to hear from more syndicates, what questions we didn't ask about the syndicate that we should have asked. You can tweet at us at UpsideFM or email us hello@upside.fm, and we'll talk to you next week.
That's all for this week. Thanks for listening. We'd love to hear your thoughts on today's guest, so shoot us an email at hello@upside.fm or find us on Twitter at UpsideFM. We'll be back here next week at the same time talking to another founder in our quest to find upside outside of Silicon Valley. If you or someone you know would make a good guest for our show, please email us or find us on Twitter and let us know. And if you love our show, please leave us a review on iTunes. That goes a long way in helping us spread the word and continue to help bring high-quality guests to the show. Eric and I decided there were a couple things we wanted to share with you at the end of the podcast, and so here we go. Eric Hornung and Jay Klaus are the founding parties of the Upside podcast. At the time of this recording, we do not own equity or other financial interest in the companies which appear on this show. All opinions expressed by podcast participants are solely their own opinion and do not reflect the opinions of Duff & Phelps LLC and its affiliates, Unreal Collective LLC and its affiliates, or any entity which employ us. This podcast is for informational purposes only and should not be relied upon as a basis for investment decisions. We have not considered your specific financial situation nor provided any investment advice on this show. Thanks for listening, and we'll talk to you next week.
Never mind, bro, that can't be matched. I'm lighting it on fire, used to run victory laps, and still I'm not even tired. It's all about the timing, yeah, that's what they say. Well, I'ma keep